At Option Genius, we believe that you deserve freedom, financial freedom, so that you have no more worries and more than enough money. Time freedom, so that you could do what you want, when you want to do it. And choice freedom, to live your life on your terms. But the system and Wall Street are rigged against us little guys. So how do we fight back? Well, my friend, that's what this podcast is all about. My name is Alan Sama, and this is the Option Genius Podcast. Hey there, Genius Nation. Hopefully the markets have been kind to you so far. In today's episode, I wanted to talk about what option selling actually is. Now, I realize that we've done many episodes already where we talk about why you should be selling options, but never gave an explanation. It's probably one of the first things we should have done, right? So we'll go back to the basics on this one. Now, you might already know that I run an options trading advisory called optiongenius.com. This is a membership where people pay to get access to my trades. So if you want to see how I trade options, you can become a member and then see them for yourself. Now, when we started the site in the beginning, the headline across the top of the website was takes to make 8 to 12% a month. Because at that time, we were offering the first month of membership for just $1. And potentially with our trades, you can make 8 to 12% a month. Now, of course, there will be some losing months, but even with those, there have been years where we have made well over 100% a year. So it's totally doable. We have made well over 100% a year. So it's totally doable. The problem is that most people don't believe it. Most people don't believe you when you tell them that you can make 10% a month because they've never heard of trading options the way we do it. And some of these people do happen to work at some large companies like Facebook and Google. So here we were growing like crazy, hundreds of people joining our site every month, when I guess we just got too big. So Google reached out to us and told us to tone down our marketing. Well, they didn't really say that exactly. They just shut off all our ads with no notice. So there we are, we're spending all this money on advertising, and all of a sudden there's nobody coming to the website anymore because the ads weren't running. So finally, when we were able to contact somebody about it, they said that they didn't believe us, even though we had plenty of proof and testimonials. So they made a, quote, safer language to explain what we do. So here is the definition of what an option seller does as approved by Google. OptionGenius.com uses a market-neutral strategy. This strategy takes advantage of market reality. Short-term market direction is a T. Short-term market direction is extremely difficult to predict. What we do is similar to what insurance companies do. Insurance companies profit from highly sophisticated probability models in order to collect more in insurance premiums than they pay out in claims. This results in paying more money in insurance premiums than they ever receive in claims. Similarly, option buyers often pay more in option premiums than the profits they receive, losing money in the long run. Our market-neutral strategy aims to take advantage of this by collecting option premium, uses high-probability hedging methodologies to generate option income. Positive returns are generated, independent of market direction, through equity and index option structures with well-defined risk option strategies. Probability models have been implemented to improve the risk-reward characteristics and increase overall returns. Thanks, Google. I'm sure nobody is confused by that. Even if I read it to you maybe another 10 times, it'd probably still be too confusing. So anyway, over the years, we have been able to redo the site so that it actually makes sense. But what this description was trying to say, let me explain it to you in English, is that option sellers trade in a market-neutral way. So you don't need the market to go up or down to make money. You can trade it even when it doesn't move. Like when it goes sideways. Yes, it can go up. We have strategies for that. We have strategies to make money when it goes down, and we have strategies when it goes sideways. Okay. Also, option sellers have probability on their side. So we do trades that have, for example, a 70%, 80%, or even 90% probability of working out in our favor. These calculations are done using sophisticated statistics and mathematical formulas that have even won the Nobel Prize. Yes, there was a couple won the Nobel Prize for their figuring and their calculations all about options. Now, in addition, to be even safer, we use other risk management techniques like stop losses and spreads, which actually limit our losses. So you have a great probability of success in the first run, and then you also have risk management, and then you have spreads. And given the example of the insurance company, okay, so just like the insurance company collects premiums, so do option sellers. In fact, it's an awesome one because as we talked about in episode number 8, the real reason options were created were as a way to lose money. They were created as a hedge, as insurance. So the option seller acts as the insurance company by selling options to farmers, to manufacturers, and investors who are looking to protect their positions. Now, that's one way to describe the option seller. That's one of the jobs of the option seller, to provide insurance. The second one is as a casino. Gamblers and has the odds in its favor, right? Over the long run, we all know the house always wins. Now for us, the gamblers are called speculators. These guys are the option buyers who are betting against the odds, hoping for a big payday. Kind of like lottery ticket buyers. The option seller is the house, and it takes the other side of the bet. So once in a while, the option seller loses, but over time, the house always wins, right? It's just math. And with the odds in my favor, I don't really care which way the market goes. I don't have to predict it. Couldn't predict it because I'm just not that good at picking direction. If I want to do a bullish trade, I can, but I don't have to be right to make money. This removes so much of the stress of trading. So when you have a 70%, an 80%, even a 90% chance of winning on a trade, you don't have You don't have to be the best trader in the world to make money. I'm living proof of that. So you see, when you buy a stock, right, there's only one way to make money. It has to go up. And if it doesn't, then your money is just sitting there, not doing any dead money, unless it's a dividend stock and you get like some measly return, like 2%. But if the stock goes down, you actually lose. So you have like a 50-50 chance. Hopefully it goes up. Hopefully it doesn't go down. You have to be right about the direction. It is the same with buying options, except it is exponentially harder. Not only do you have to be right about the direction, but you have to know by when the move will take place. When will it go up? And how much the stock will move. If you are wrong on any of those three, if you're wrong on even one of those three, you lose. Okay? So you get to play a range, okay? The stock does what it wants, and as long as it stays inside of this range that you give it, that you decide, you win. So let's use golf as an example to make this simpler, okay? Those of you who play golf, even if you don't, this is still going to make sense, okay? Those of you who play golf, even if you don't, this is still going to make sense. To make money with stocks, okay, you have to get the ball into the hole in 3 strokes. So you can only hit it 3 times. Hit, has to be in the hole. That's how hard it is to make money with stocks. It's really hard to do that in 3 strokes. To make money by buying options, it gets harder. You actually have to hit a hole in 1. Okay? That's doable, but very rare. Super rare. But to make money by selling options, all you got to do is get the ball onto the course. Okay, now I'm not a big golfer, and I've only been golfing once, and every time I did not get it on the course. So For me, it's a little bit harder. Golf is harder than selling options for me. But if you get the analogy, right? You're making money with selling options. Buying options? Oh, you got to hit a hole in one, my friend. That's almost impossible. Get it into the hole with 3 strokes? That's selling stocks. That's also pretty hard. One additional point I want to make about this is that emotionally and psychologically, winning more often does wonders for your self-esteem and your confidence. And as a trader, having confidence in your trades and in yourself is a key factor to success. So there are people out there who do day trading and they'll tell you that, I'll do 1,000 trades and I'll lose money on most of them. But if I have 1 or 2 big trades, big winners, I'll be okay. Well, can you imagine what that feels like? Putting on a trade and losing and losing and losing and losing and hoping and hoping and hoping and hoping. It's kind of like those people at the slot machines. You keep putting money in, you keep telling yourself, oh, the next one might be the big one. The next one might be the win one. And that's how they get addicted. But on our side, we're winning most of our trades. And so we're happy most of the time, which is, to me, that's a better way to do it. Because that's the goal. We're not trying to hit home runs. We're trying to hit base hits after base hit after base hit. You hit a single, hit a double, hit a single, hit a double, hit a single, hit a single, and a single. You're just looking for the RBIs, the runs batted in. Because everybody knows what happens to the guy who tries for the home runs. If that's the only way you can score, you're going to strike out most of the time. And in investing, a strikeout means losing money, which is not a good thing. Okay? And now everybody knows that if you want to win baseball games, you want to win ball games, you don't want the home runs. You can hit home run, that's great, but you want to hit the RBIs. You want the hits. You want the singles and the doubles, because that is how you win baseball games. And if you don't believe me, go watch the movie Moneyball. Okay? That whole movie is about a guy who looked at the statistics. And he had to put a team together, a baseball team together, and he only looked at statistics. He didn't care how good the player did in the outfield. He didn't care what they looked like. He didn't care what their potential was. He looked at how they were doing, and he picked the players that got on the base. So if they were to win. So we're talking about the same thing here. We're using Moneyball in options trading. Okay? So let's do a couple examples to make it a little bit clearer for you, right? I always like using examples because, that's real world stuff. There are so many strategies when you talk about options and selling options, but let's stick to a couple of the more popular ones. So we have a stock that is moving higher. Okay? I don't care what the symbol is. It doesn't matter. It doesn't matter what the company does. The stock is trading at $100 per share. And for the past 3 months, it has been moving higher a couple. So 3 months ago, it moved up $3, let's say. Last month, it went up $2.50. This month is moving up a little bit. And right now, it's trading somewhere around $100. So that's great. Okay? That's awesome. We have a stock. It's moving up. That's nice. We could buy the stock and we can make, a couple % a month maybe in this nice, we could buy the stock and we can make, a couple % a month maybe in this nice really stock that's just been going up and going up. Of course, it could turn around or it could stop going up. It could just go sideways. We don't know that. So instead of that, what we can do is sell a put spread on the stock. Now, this is called a credit. Get paid for this trade. You're going to get a credit. So we're selling this put spread. Okay? What we can do is a trade that gives us, say, an 80% probability of profit. So 80% of the time, this trade is going to make money. The trade is only going to last for 30 days. And that's when these options will expire. They'll expire in 30 days. And this trade can give us a potential return of 10%. Okay, now these are all things that we choose as the option seller. I can choose what probability of profit I want my trade to be. I can choose when to get in the trade and how many days to expiration. I can be a profit, 30 days to expiration, and a 10% potential return. Now keep in mind, if we bought the stock, it's only moving up, a couple %, 3% a month. over here with this trade, I can make 10%. Okay. Now, since we are selling a put spread, that means we want this. Now, since we are selling a put spread, that means we want the stock to move higher and stay above the strike price of our sold put. Now, I haven't told you what that means. So, for example, if we sell the 90.85 put spread, we want the stock to stay above $90 a share for 30 days. Okay, so we're selling the 90.85 put spread. A spread is basically two options. So we're selling the 90 strike put and we're buying the 85 strike put. We want it to stay above strike put. We want it to stay above $90 a share. Right now it's trading at $100 a share. We want this to happen for 30 days. Now, this is a stable company. It's been moving higher. So what are the chances of the stock dropping 10% in 30 days? That's pretty low, right? Actually, because our probability of profit is 80%. But there is still a chance, right? There is still that 20%. So what we want to do is we want to protect ourselves too. So that is why we did a spread. That's why we bought the 85 put. So in a spread, you sell one put to collect the premium, and then you buy another put to protect yourself and limit your loss. So you actually have to pay for that one. Now in this case, we did the 90.85 strike so that we cannot lose more than $5 on this spread. $5 per share or $500 per spread. Okay, so you can lose on this trade, $500. Even if the stock goes to zero, we can still only lose $500. If the stock drops below $85, that's the put we bought. That put will increase in value and offset any loss. So in reality, we have a limited loss at any loss. So in reality, we have a limited loss. Okay, does that make sense? So to recap, we have a trade with an 80% probability of working out in our favor. The trade's only going to take 30 days long, or even less if we decide to get out of it sooner. We can make a potential return of 10, and we have a limited loss of $500 per spread, which is the most we can lose. So sometimes people ask me, hey, what's the minimum I can do? What's the least amount of money I should have to get into options? I always suggest $10,000 is what you should start with, $10,000, unless you're doing paper trading, and then you don't need any money to do paper trading. You could just do it for free. But if the minimum probably $5,000. But here we have an example where we're only using $500. So if you only have $500, you can do this particular spread or a spread like this one. In fact, you can go all the way down to $100. You can do a similar spread with $100. Now, we have identified a stock that is in an uptrend and it is moving higher, right? That's what we said originally. So we are trading with the trend. We're going with, and we expect the stock to continue to move higher. That's what we were thinking. But even if the stock starts going sideways, or even if it moves down a little bit, the trade will still profit as long as the stock stays above $90 a share, which would be a $10 drop in price. It has to drop more than $10 for us to lose money on this trade. That sounds pretty good, right? Yeah, it sounds good to me. Now you might be thinking, doesn't mean I would do all of them though, because of other reasons. But if I wanted to make this strictly on math, if I wanted to find like a scanner, like a trade scanner, and have that software find trades for me based on these criteria, then I could do thousands. I could find thousands of trades like this instantly. Now, again, I said it doesn't mean that I would do all of them, because I like to use my own noggin a little bit and only trade on certain stocks that have been behaving in a way that I like them to behave. And I avoid trading during certain times. Like when there's a Fed announcement coming up, like the Federal Reserve, if they're going to come out and say, we're raising rates or we're dropping rates or whatever, I might stay away and not trade when they're going to be announcing something. Or when a company is releasing their earnings report, which they do every 3 months, that can make a stock go up and down unexpectedly. So I probably will not trade during that time. So these different things, these different criteria that I have, they only increase my chances of having a winning trade by staying away from risky trading times. Okay, so that was the put spread, known as the bull put spread for those of you, or it's called a vertical. Some brokers, they call these verticals. I just call them put credit spreads. So now let's look at another example, shall we? So this is the same stock, but now it is again trading at $100, just moving sideways from month to month. I mean, it moves up a couple bucks and then it comes down and then it stays near 100 the whole time. So over the past few months, it's been trading near $100, and we think that it's going to continue to go sideways and trade near $100. So what we can do here is a strategy called the iron condor. Whatever, I didn't come up with it. So how it works is we would still sell the put spread exactly like we did in the first example. Now, even if the stock is going sideways and we only did the put spread, the trade would probably still work. But because this sucker is moving sideways, what we can do is we can also sell a call spread. Right? There are two types of puts, right? There's a puts and then there's calls. So we already sold the put spreads on the bottom side. Now we can sell the call spread on the top side. That can actually double our return, additional risk, or capital needed. All right? So we have the stock trading at $100. We sell the put spread, the 90-85 put spread. Okay? So we are safe for 10 points for the stock going down. Same as the last time. Then we also sell the 110-115 call spread. So this spread would win if the stock is trading below 110 at expiration. So we have the choice. If a stock is moving sideways, we can either do the puts, we can either do the calls. Both of them could probably win, so sometimes we can do them both at the same time. Okay, so now we have this zone or this box around the stock. We want it to trade in between $90 a share and $110 a share, keeping in mind that for the last few months, it's been trading right around 100. Have to drop 10% or go up 10% for us to lose money. Now we can make 10% return for the puts, and then we can make another 10% return for the calls. So now we can make 20% return on our money in just 30 days. But our max loss is still the same. Why? Because the trade can only lose on one side. At expiration, the stock can only be up or down, right? Not both. Both of these spreads cannot lose. One of them has to win. A stock moving sideways, you can also trade other strategies. There's so many of them out there, and they all have all weird-ass names, like the butterfly spread, the time spread, which is also called a calendar spread, the diagonal, the ratio, the box spread, and many, many others. And we haven't even talked about two of the most common strategies out there, the covered call and the naked put. I mean, maybe we'll leave those for another episode. But as you can see, you have many options when it comes to selling options. Pun intended. So that's why I like to refer to selling options as selling time. Expiration date. After that date, the trade is over. The options go away like magic. Poof. And every day that you are in the trade, you get closer and closer to expiration. And so the options lose value every day. Basically, you're getting paid for waiting. So yes, Virginia, I do have time on my side. Okay? And that is how you trade with the odds in your favor. I end with every episode with that, right? Trade with the odds in your favor. Well, that's how you do it. Now, there is one thing I want to mention really quickly. Some of you math nerds might have noticed that we can make a 10% return on this trade, but it has a 80% probability of profit. So what you might be thinking is that, okay, 8 trades out of 10, you make money. 2 trades, you lose money. So you're not making 10%, you're losing 90% on that trade. So the math doesn't work out. Well, if you look at it that way, then that's true. If you do nothing, if you just put the trade on and either lose or win, then yes, there's a really good mathematical probability that you'll probably lose money. And that is why we never take the max loss. So in these two, trade. But if the trade is going against you, you would have to be an idiot to sit there and not do anything about it. Right? So that's why we have something that we have a stop loss. That is an amount that I have as a limit. So if I'm in this trade and I lose, if it goes against me, if the odds don't work out, if the trade doesn't do what I think it's going to do, and if I'm down a certain percentage amount of money, then I'm just going to take my money off. I'm going to take the trade out, I'm going to get out, and I'm not going to risk having this max loss. So yes, there is an easy way to get around that mathematical issue. Okay? Now, if you want more details into the trades I just described, and if you want actual real-life money trades that we've done in the past, and you want specific examples with, like, how much credit did you get and how much was the stock really trading at and all this stuff, just head on over to optiongenius.com, sign up for our free 9-lesson course on selling time. It'll be emails delivered to you. We also have it on our website. You can read it pretty quick. It'll give you real life examples and it'll go deep. Great way to get a little bit more information and to get some real life examples and to go into it. So folks, that's it for this episode. Until next time, remember, trade with the odds in your favor. All stocks are not created equal. We've analyzed thousands of optionable stocks to find the very best ones to trade options on. Lucky for you, you can just download the list for free. Get it at simonsaysoptions.com/stocks. Again, that's simonsaysoptions.com/stocks.